In the Wealth Circuit Investing Discord group, a fellow investor requested my thoughts and opinion on Teradyne. Every person is different and may invest in different assets to meet their individual investing goals. What may be good investment for one person does not necessarily make it suitable for others. In this video, I'll look briefly at Teradyne along with the latest quarterly results. We'll review a few sites providing information about the company. SeekingAlpha for summary information, financials, earnings, and dividends. Simply Safe Dividend site for their analysis and overview. FASTGraphs to look at the current valuation and analyst estimates. StockCharts to review the technicals for price action, relative strength, and momentum. And finally, TickerData for screening and intrinsic value. Teradyne provides products for defense and aerospace, signal testing, memory testing, power and analog tests, board testing, storage tests, system and wireless testing. They also provide autonomous robots and collaborative robotics. Let's take a look at the Teradyne latest quarterly results, Q3 of 2024. We can see that they had sales of $737 million, which was slightly below their guidance range. They had the gross margin of 59.7, which is really their target area. It has been lower than that in the past couple of quarters, but that is definitely just slightly above their guidance. And then the non-GAAP EPS, which was 90 cents per share, is slightly above guidance as well. For their segment summary, their semiconductor test unit, the sales were up 9% versus the same quarter in 2023, but in system test and wireless test, they were both down for those quarters, and the robotics was slightly higher than the quarter a year ago. Moving to the SeekingAlpha summary page, we take a look at the 52-week range. They've been trading between $81.08 to $163.21 over the last 52 weeks. They have a forward EPS of 3.18. Their PE is currently, on the forward looking, is currently 35.18. They do pay a dividend, which is yielding 0.43% currently. They are a large market cap in the semiconductor materials and equipment industry. If we look over the last year, they're up about 27.12%. But if we look at the year to date, they're only up about 3%, just slightly less. Moving out to the 5-year view, they're up 75%. 10-year, they're about 512%. We'll come back to their earnings here in just a moment. Take a quick look at that. If we look at the seasonality, their weakest quarter was the one that we just completed, and their last quarter, they typically have pretty good years. And on their latest earnings, as I mentioned earlier, they did exceed their revenue and their EPS targets, but the stock price was negatively affected by this particular report. Turning to the Teradyne financials, we'll take a quick look at the income statement. We can see that the revenues between 2014 and 2021 were generally rising, but over the last couple of years we've seen a trail off in the revenues due to some weaknesses in some of their businesses. If we look at their average shares outstanding, we can see through 2014 to 2023 that they've had a decreasing amount of shares outstanding. When I listened to the earnings call, the CEO and the CFO mentioned that they often issue shares for employee compensation and their employee stock ownership purchase plan, but typically they buy back more shares than they issue for those cases, so that's pretty good news. We can see that the EPS basically followed the revenue pattern, so it was increasing from 2014 to 2021 and a trail off in December of 2022 and 2023. We go to their balance sheet. One of the more outstanding things on Teradyne's balance sheet is their debt profile. So at the end of 2023, they had about $819 million in short-term investments. Their total current liabilities are $660, so they actually have more short-term cash than they have short-term debt. They could easily pay that off, giving them a good current ratio. Their long-term debt, they basically don't have any since the end of 2022 through current, so they don't have any long-term debt. That's really outstanding accomplishment for this particular company. We move to the cash flow statement. Here's where I mentioned stock-based compensation. So they are giving shares as employee compensation, but to offset that, they're buying back more shares than they're issuing. Once again, their long-term debt, they basically don't have any debt. And if we look at the free cash flow, it's been a little choppy over the years, but positive through 2014 to 2023. We'll move to the SeekingAlpha earnings page, and we can see that they've beat the normalized actual EPS by 11 cents, and they beat their revenue estimate for the recently reported quarter. If we look at their earning estimates, we can see that they had a drop down into 2023, but they are expected to increase those to about 318 in 2024, and analysts are expecting increasing estimates out through 2028. So we can see that it's a 8.4% year-over-year growth for this year, 33% for 2025, 41.8% for 2026, and that's where they have the most number of analysts. So we can ignore these two and for 2027 and 2028 because there's only one analyst that's providing any estimates there. If we turn to their dividends, we can look at their dividend history. And the dividend stayed pretty flat in the year 2020 through January of 2022. So basically 2 years they were flat. Then from 2022 to basically 2024, so for another couple of years they were flat. And then they've raised them in 2024 to 12 cents a quarter, and they've been paying those out for 3 quarters. We'll move to Simply Safe Dividends and take a look at Teradyne. Simply Safe Dividends give them a safety score of 74, have a yield of 0.43%. They're basing their valuation off the dividend yield, so they're saying that they're reasonably valued because they're at their 5-year average. I think this is a little bit high, and we'll take a look at this in a couple of other tools here shortly. Their dividend growth was 9.1% on the last raise. I noticed that they have a pretty high beta, which is always concerning for someone like myself that's retired and looking for a little stability in the price action of an equity. This gives me some pause. It doesn't mean it's not for someone else, but for me it's a little bit concerning. Their payout ratio is pretty low, only 15%. We can see that during the 2007 through 2009, during the recession, that they had a sales loss of 36%, and their recession return was down 76%, which basically trailed the S&P 500's 55% loss. Now we can look at their dividend growth here. They've had 9 years of uninterrupted dividends. So Simply Safe bases their valuation on the dividend yield, and they're giving it a fair evaluation based on that dividend yield. Like I said, I think this is a bit high, and we'll take a look at that in a couple of other tools. So they're sitting right at their 5-year average dividend yield. Their forward PE ratio is a little bit above its historical norm. If we take a look at the financials, their payout ratio is very good. Free cash flow payout ratio looks really good. The earnings per share was steadily growing up through 2021, then started decreasing down through 2023, and it looks to be increasing over the last 12 months, and it is expected over the next 12 months to be increasing. Free cash flow looks pretty similar. Earnings per share 2022 and 2023 was actually at a loss, but they have recovered since that particular time. Sales growth looks exactly the same for 22 and 23. We mentioned the shares outstanding. You can see that they're decreasing over time. Total sales pretty much follows the pattern we've been seeing, where it increased through 2021 and then has been decreasing over the last couple of years, with a slight increase over the last 12 months. Return on equity is sitting at 19%, which is above the 15% that Simply Safe looks for. Return on invested capital is 20% for 2023 in the last 12 months for 18%, which is above the 12% that's preferred. Operating margins are above what's preferred. Free cash flow margin looks good, and they don't have any debt, so their net debt looks fantastic, and their interest coverage looks pretty fabulous as well, way above what the preference is for Simply Safe dividends. When we move to FASTGraphs, which is one of my favorite tools for looking at valuation of companies, we can see that Teradyne is trading historically above their historical averages. So they currently have a blended PE of 35 times, which is sitting above their normal PE, which is the blue line, which is 20 times. And then their fair value ratio, which is based upon, we can take a look here at what its focused on has to do with using the Graham's formula for growth, but gives them a 15 times at the fair value. So they did have these decreasing revenue and EPS values over the last couple of years, but they are looking to be increasing those over the next couple of years. But if we take the current price and even take it back to their normal PE ratio, if we look at that, we can see that over the next couple of years, they'll be returning about 2.46% on an annualized basis is that expectation. If it trades at their normal PE rather than this elevated trading range that I think is based on some of the AI hype and their partnership with NVIDIA. I'm not for sure that that's going to continue to put Teradyne at a premium valuation. Next, we'll take a look at the technicals on StockCharts. Teradyne reported earnings on January the 30th, missing revenue target but beating earnings per share. The share price dropped 7.65%, taking 20 days to recover. On March 19th, Teradyne reported an NVIDIA collaboration with little price movement until the next earnings report nearly a month later. The report earnings on April the 24th beat on the top and bottom lines with the 8.15% initial response and rallying 62% over the next 58 trading days. So we can see that 56% or 62% here. Then on July 18th, Northland Capital downgraded Teradyne from outperform to market perform on valuation and trade risk about 6 days before the earnings announcement. Then Teradyne reported on the 24th, and the initial response was a 13.38% drop in price. The stock price consolidated for the remainder of the quarter and then dropped another 11% on the latest report despite a beat on the top and bottom lines. Teradyne, from a seasonality perspective, is entering a strong quarter, but I expect Teradyne to trade sideways for the next quarter until they announce their 2025 guidance. The RSI is showing an oversold condition and is at its lowest range since November of last year. The MACD is below the zero line, and the divergence is growing. If I were to consider Teradyne a short-term trade, the absolute earliest that I would enter is when this divergence began to roll over. For a medium-term trade, I would want the histogram above the zero line. And for a long-term trade, I would wait for pricing nearer the intrinsic value, which we'll discuss shortly. Teradyne, on a relative basis, is underperforming the SPY by about 10%, and they are underperforming their industry by over 40%. If we look at it from a sector summary, we can see that their most direct competitor is up 52.65% for a van test, and we have to scroll down to just barely above the green line to get to Teradyne, so it's up about 3.29% this year. If we look at the long-term, medium-term, and short-term trend, we can see that the long-term trend is decreasing. The medium-term trend and the short-term trend are below the zero lines. So for a longer-term trade, we would want to see these turning more positive. I'll quickly show some pertinent data from the stock screener that covers the years 2013 to 2023. You can pause the video if you wish to review these in more detail. So this is the screener. If we look at the profitability and income, you can see the numbers here. Look at the balance sheet and the dividends. So for a stock valuation, we'll look at this valuation spreadsheet. We'll be using the Graham's valuation, a discounted cash flow model, multiples valuation, and the dividend discount model. The output tab summarizes the four models. So for Graham's evaluation, the growth rate is expected to be around 17. The yield on AAA corporate bonds is about 5.06. So that gives us an acceptable buy price of $54.62 with the 10% margin of safety. If we look at the discounted cash flow model, taking into consideration their cash and their total debt, we come up to a DCF price per share of about $39.60. If we look at the valuations comparing others that are similar to Teradyne, with Avantest being one of their closest competitors, we can see their PE multiples, get the average PE, look at the earnings per share in 2023 for Teradyne. That gives us a stock price of $145. Then if we go to the dividend discount model, considering that we expect an average growth rate of about 6%, we come up with a dividend discount model price of $8.48. If we look at the output tab, which summarizes the four models, it shows an average intrinsic value of $63.69 per share, with the 10% margin of safety would give us a buy price of $57.32. Since the dividends are not a huge driver in the valuation, if we actually remove that, we get an intrinsic value of $82, which I think is pretty close to what the intrinsic value actually is. With a 10% buy price, we would get an acceptable buy price of $73.88. I hope you found this video useful and wish you the best with your investment journey. Please like and subscribe to the channel to help promote. You can also follow me on X and LinkedIn. If you want to support the channel, you can scan the QR code to buy me a coffee. Thank you so much, and we'll talk to you again soon. Bye.